Hello, everybody. It's Jake Gino, host of Jake Gino podcast here with my co-host, the multifamily mentor, the coach, chef, the father of six, the best-selling author, the G-Daddy. Gino Barber. Gino, how's it going?
Jake, I'm doing great today. You know why I'm doing great? Ask me why.
Tell me. Why are you doing great, Gino?
Your microphone is finally working spectacularly.
Is it? I'm just yelling into it. That's why.
Okay, it only took like 8 years to figure it out, but better late than never. But You sound awesome today, brother.
Well, that's good. I get real close to it just for you. But we have a very special guest today. I think you guys are going to have a lot in common based on what I've heard so far. But today's guest is a serial entrepreneur, real estate investor, and the founder of 30 Capital, a company transforming the commercial real estate world through data, technology, and financial services. He's got a new book out as well, so we're excited to get into that. So without further ado, Rob Finlay, welcome to the show.
Thanks, guys. Thanks for having me. It's good to be here.
Hey, it is our pleasure. Let's just kind of meeting each other. Let's hear your story and how you broke into business, and then we'll get into a little real estate and maybe touch on Hey Dad too.
Yeah. So grew up in a real estate family. So pretty much all my life, all I had was basically understanding real estate. But like a typical kid, I didn't want anything to do with real estate. My dad was a broker and a property manager, and I'm like, nope, I want to go to Wall Street. I want to go, be an investment banker.
None of that looks cool as a kid, right?
Yeah, it's really cool. Plus, at my age, like Wall Street was a real movie. Like that was like, you aspire to be that kind of stuff. And but unfortunately, I just didn't have the grades to do it, other than to go through real estate. So was fortunate enough, got on with Lehman Brothers and then Credit Suisse First Boston and their principal transaction group. So really had like these, for the people who understand that space, that was Harvard for me. Like that was like the best of the best. And, but one day I just said, you know what, I'm struggling.
Were you Lehman during the crash?
No, this was, I'm a little older
way before that.
Yeah. So
okay.
This was back in like 96, 97. And then basically in 2000, in early 2000, I came up with an idea to start a company, this very specific esoteric thing that only deals with commercial real estate finance. But I said, you know what, I'm going to do it. What the hell? I struggle with being an employee anyways. So I mortgaged my house, did everything I possibly could, and started a business. I was very fortunate. It was called Defease with Ease, which is sort of the process.
It's a good play on words there.
Yeah. Well, the process of a defeasance. If anybody, your listeners, I'm sure
you're like the guy that gets people out of these timeshares. I could see the commercial online right now, right?
Yeah. Well, it's a little bit like that, but it's more for like fixed rate loans on commercial mortgages. They're all packaged together and stuff. But I was like, it was actually we actually had two names because. If part of it was like I wanted to make a joke and say, Defease with Ease, and it was a very complex process at the time. But like one of my first calls was like from a big institutional company, and they're like, "Yeah, we have a $350 million deal." I'm like, I can't call myself Defease with Ease. I'm like, "Oh, we're commercial defeasance." So we went around. So for the longest time, many people we'd go to these conferences, and they'd be like, Oh yeah, no. We'd have like Defease with Ease, and they'd say, "Oh no, we use commercial defeasance." And we're always like, "Oh, they're much better than we are. You should stay with them." So, just the fractured name for a bit, but grew the business. But being a one-trick pony, sort of had to evolve with commercial real estate. So we started doing defeasance, built that business up, started doing derivatives, caps, swaps, and then ultimately to where we are today, we basically help real estate borrowers make better decisions based upon debt. A lot of real estate owners and operators are really good at the real estate, but the debt is sort of a byproduct, right? They you can go to any real estate owner and they can tell you every specific thing about their property, rental rates, markets, occupancy, everything like that. But if you ask them, hey, what's your weighted average, coupon on your portfolio, or what's your duration matched with your NOI? They just don't know that. And so we really made it a business to try to transform debt management to a point where property managers help manage properties, where debt managers, we help owners manage their debt and make better decisions. And that's where we are today.
And, in the book, Beyond the Building, I think everyone should go check it out. Wall Street Journal bestseller. Rob's got tons of resources. Go to beyondthebuilding.com/book. I want to jump into, the OKRs and the KPIs, because that's something that Jake likes to geek over. And I think
Are we doing this for the debt specifically though? Because that's exactly where my head's at. Like the KPIs for the debt.
I mean, you can go through customer acquisition, tenant retention. There's so many different KPIs, and if you go over what the OKRs are, it's the objective key results, and then what the KPIs are, the key performance indicators. They measure the key results. Can you define both of those, and then maybe give people an idea of what some of those metrics should be, what they should be tracking in their real estate business?
Sure, sure. Well, let's first step back a little bit because you mentioned Beyond the Building, and I think it's important to note that the book is really about trying to get commercial real estate owner and operators to think less about the individual properties, but more as an enterprise, right? So a lot of times we use these metrics, these KPIs on our properties, occupancy rate, whatever. I mean, there's millions of them, but the companies themselves, are they using metrics to judge how well they are doing their job? Because if a real estate company is really a private equity shop, right? They take people's money, or their own, and they go out and they invest it and they show returns and they operate it, and they're an operating business. And so the whole premise of the book is for these real estate companies to really start thinking more like a technology company, be innovative, think differently, and utilize the things that some of these best-in-class real estate companies have, and best-in-class technology companies have utilized to become successful. So that's the OKRs and objectives and key results. Back to your question, yeah, objectives and key results. Like objectives are sort of where you want to go, right? They're high level. Hey, we want to be the leader in whatever, multifamily development. Well, what's a key result of that? Well, a key result of that is we're going to have 10,000 units by whatever, 2030. And then the metrics beyond that is the actual key points to get to that point. So it's really important for these organizations to not just set goals, but to set the objectives, and then what happens when you make those objectives. And then make sure that everybody in the organization, everybody has to understand those OKRs.
Jake likes to say often that he wants to become, or we want to become, the Chick-fil-A of the apartment industry. We want to be able to deliver superior customer service to the B and C space. That's where we are. So if that's the premise, what are some of those KPIs or some of the things that we should be tracking in our business to allow us to do that?
Well, let's go. Who's your customer, right? So I think you have to barrel it down to, you have to be more like, let's get really specific. Let's get granular and look at personas. Who is your customer, right? And so in this case, you said your goal is to be the Chick-fil-A of multifamily, B and C multifamily, right?
Mm-hmm.
Okay. Well, Chick-fil-A to different customers, right? As a customer of Chick-fil-A, love Chick-fil-A, but why do I like it? Is it the chicken? The chicken's not bad. Or is it because of the organization, the way I can go in, right? Do you like Chick-fil-A because you're a franchise owner, right? So it comes down to, when you say that you want to be the best, the Chick-fil-A, to who?
Mm-hmm.
To the end user, because because it's the my pleasure that we aspire to achieve.
Okay, so then your consumer, then your customer is the resident.
Mm-hmm.
Okay, so in that point, from that resident, so how often are you doing surveys? So I think one of the things that we've seen, and being involved in technology and building companies over the last 25 years, all focused around the commercial real estate space, some of the key things that get started, some innovative things that get started in commercial real estate, typically get lost because of cycles. So a few years ago, we were basically going out and monetizing the behaviors of our residents. So I own multifamily as well, and I wanted to do the same thing. I wanted to create this experience for my end user, my resident. And so we had apps that would track, what are they doing? What do they like to do? And so in order to be that great provider of service to your customer, you have to really know their wants, their needs, and their fears. And also breaks down the segmentation of them. How many of your residents have dogs or pets? How big is pets associated with your residents? Are you fulfilling that? Are you putting those specific type of things that they like? Are you moving those over to your apartments? Like pets, it's a big one. How much are you spending on dog grooming areas and dog playgrounds, dog parks, things like that? So those are the things. So breaking down into those KPIs, it comes down to knowing the people that you want and then tracking the specific KPIs to those people.
I've seen the net promoter scores that we use as the best way to gain that information, and then the cool thing is when you see the commonalities in the responses, you can then respond back to your monthly newsletter to the residents when those ideas are being implemented, and then the community feels heard, and I think it's really helped. We've seen I don't know. What do you think? 3 years now we've been doing net promoter scores, Gino, maybe longer.
We're almost at excellent, right? We're scratching the
That's
excellent
great.
point, which is like when the 50s. It feels like it
You're in
feels
the yeah. You're no. We've hit excellent. So we're like one below the world class, but we're at the lower end of excellent right now. It was like 50, low 50s, and but we've sort of hit this curve now where it's taken some time, but the I think the commitment to it over time has led to that higher acceleration that we're starting to see now, and the commitment to customer service. And the other thing that's really helped us is really putting a lot of attention on the work orders and making sure those are getting turned around in 24 hours. And we have a big board for the maintenance team, so they're listed. How many open work orders are there, and how quickly are they being closed out? So all those things lead to that bigger goal. Guys, if it's okay, I'd love to pivot back because when you started talking, I don't know if we want to call them KPIs for financing or whatever, but we break our business down into buy right, manage right, and finance right. Sort of, to your point where there's this whole financing component and people are lost. I think one way that helps is when you're using the agencies and you're using the insurance companies, they give you different guidance and assistance when reviewing the debt, but also you were starting to throw out KPIs. I think you were talking about like what's your blended rate. I think you're talking about interest rate, duration risk, and things. What are the top three or so that you look at, or things that we should be looking for from a financing perspective that you see many operators lacking?
So the number one, so I think this is my number one thing with all of interest rates and debt associated with commercial real estate loans. And this isn't just multi, this is all, is looking purely at coupons, right? So you look at coupon to coupon and that's it. And a lot of times, especially in markets where you have properties that are maybe accelerating quickly, or you have where your NOI, like value add, for example, right? Value add, trying to put a long term debt on a value add is crazy, right? You think you're
In
setting
those
an
first couple of years, because you're repositioning, you're going to need to recoup via refi. Just to
you want to recoup, and that
yeah,
comes back to which is my bigger point. Right now, if you have when you're looking at your debt, and to me, debt also includes preferred equity, right? So to me, I know that, and I know people don't like to say this, but the goal of a real estate company is to accelerate their promote and get paid. I mean, that's what they do. I know you want to give your investors return, and you do. If you're hitting your promote and your money,
that's what our biggest issue with syndications were. So we actually invest our own capital, and we did a couple syndications, and that's exactly my issue with syndications, that it forces you to sell it to get back that 30% that you've been waiting for.
right? But if you don't sell it, and here's my thing, is I personally do not believe that real estate companies should sell. If you are in the business for long term, you should never sell a property unless you've hit unless you feel like the market is going to go down.
That's exactly right. There's crime, the market's dying like a rust belt or something like that. Yeah.
Yeah,
But
absolutely.
that was what was killing me inside. We did 3 syndications after once we got into it, because everyone was doing syndications. We're like, oh, let's do it. And that's exactly my struggle with it. It's hard to find these things, and if you're producing yield, there's good cash on cash return. You don't want to kill the golden goose.
But
That was always my issue.
but leverage. I mean, leverage has to be appropriate, right? I don't think real estate is one of these few industries.
What's appropriate leverage long term?
All depends on where the property is in the cycle,
Yeah.
right? I mean, in cycle, I mean from NOI. The only way to truly judge is, and we do this ourselves, and we do this as a company, and this is not only we do it for our own portfolio, but our services. We map out every quarter. We do three-year pro formas, right? Here's our base case, worst case, best case, right? But our base case is pretty much what we're expecting over the next 3 years. Because I think our asset managers have pretty good visibility. Off of those next 3 years, we look at our current debt, anything that's coming up. Hey, we're going from IO to amortizing. Okay, well, we need to think about that. Hey, my asset managers love to redo roofs and buildings all the time, right? And property managers always want to add to CapEx. Well, what does that CapEx look like? So once we know that our cash needs, our major cash needs, along with any type of promotes or preferred returns, whatever else we have to pay, from that standpoint, we now look at our debt and we run scenarios based upon what the market looks like. Do I need to have better debt, or can I keep the debt that I have? And so we're just constantly running.
Explain that a little bit more. What does better debt mean? Like, just to give me an example.
It's purely cost of capital. It's purely cost of capital. It is. I can go out in the market right now and I can deploy money and I can make 7%, right? So for me, as an owner of real estate, if I can borrow money at less than 7%, I should be doing that, right? If I know I can deploy it.
Do you have an LTV you won't go beyond, where you're like, hey, this is, I like to keep it at 70% or 65?
Well, that's usually the lender. Lenders are usually the ones
you're like, I'll take as much as I can get.
When debt was like free, yeah, there was no limit. I mean, other than what they would put on it, right? But you have to be smart about it, right? That's your job,
especially if you're talking longevity, right?
Right. And so back to our point, you can accelerate your returns and get people paid back through a liquidity event, which is debt or like a refinance or a sale. And so to me, as a real estate company, by refinancing, as long as you're in a decent market and you feel strong about the property, refinance, take money off the table, accelerate your returns, accelerate the investors' returns, and use that, because as you build your portfolio, your cost to deliver the same level of experience and proficiency becomes less, right? It's cheaper to run on a per person basis a 10,000 unit portfolio than it does 1,000 units, right? And so incrementally, your buying power becomes higher. You start being able to buy your insurance at cheaper because you can do it a portfolio wide. So all of these things, your buying power becomes so much incrementally different. Why? Look at Grace.
Maybe you have teams that do your roofing or do your decking at larger, and then it makes sense too at that point, right?
Absolutely. You think you can beat Graystar at a cost per unit of operations? No, right? And so
also they may be warehousing supplies, right, on the cheap, flooring, etc., right?
Absolutely, and you can do that when you get to size.
Do you mind if I just add a couple points to this? I think it's important that if you're a newer investor, I think it behooves you where you're starting. If you need to create equity to be able to invest equity, I think the model where you buy a deal and you trade up is fine. You guys are having the conversation as if the company is a little bit more mature, and I completely understand. As you're starting out, people need to recycle some of their assets. You typically start out, when you're first starting out, buying older, more traditional C value-add properties. As you start to mature and start to learn, return on effort becomes a big factor, and you're cycling through your portfolio. Now, Jake and I, we still have properties that we bought in 2013. The cost basis is tremendous. It's really, really low. And now they're cash flowing tremendously. We've refinanced them a couple of times. We've held them because they make total sense. We've done all the CapEx work and they're practically brand new. So understanding what you're trying to accomplish, if you're trying to do this long term and you've got a 1950s build with cast iron plumbing and knob and tube wiring, and you think you're going to own that for the next 30 years, maybe not. Maybe that's an asset when the market's elevating, you sell. So be very selective and have that kind of mindset of where you are in your portfolio. And the second part is, you said it without saying it, understanding what your exit strategy is on this deal. And that's how you couple the debt. We talk about the 3 pillars of real estate, which is market cycle, debt, and exit strategy. If you don't understand what kind of exit strategy you're employing and you don't know where you are in the market cycle, you're going to screw up the debt, even with Rob holding your hand. So understanding that is really, really important. Rob, Rob, any thoughts on that?
And that's where it comes down. And Gino, that becomes a great point because that comes down to being proactive, right? I think a lot of people, and you come back to this point, if you're looking at a market where you bought a couple of years ago, right? If you bought the last couple of years, you're pretty much holding on to it, right? And so if you're holding on to it and you've achieved some return, but you're paying your investors an 8% pref,
Mm-hmm.
and but your mindset is, well, geez, I've got a rate of 4%, or now why would I swap out into a 6% and do that? Well, because you can pay off your 8, right? And so that's my point. Is just as a real estate professional, and I use that word specifically as a real estate professional
For the IRS.
right? Well, right, for the IRS, but also look, if you're going to invest money with somebody, right, or if you're going to go do it, real estate can hurt you pretty quick if you're not smart about it, right? And it is one of these professions that, unfortunately, if you have enough money, you can go out and buy whatever property you want, right? If you're, it's not like you can just go out and be Tom Brady. You've got to go out and work hard for that. But to be a real estate person, you can, as long as you have the money and you're the highest bidder, you get the property. Mm-hmm. So you have to be a professional in order to manage and maximize what you have. And so that to me is real estate is one. And I like your concept, right? You've got the property side. Yep. You have to understand the property markets. You have to understand your debt, because your debt is the second biggest component outside of your asset purchase. Debt is the second most important. And then the third is exit. How are you going to exit it? But also be prepared if you can't exit because the market is like this.
Yeah, I have an example of exactly what you just said. I think so. And give you a little background. We do about our deals are like 10, 15 million bucks on average. That's typically what we buy. And, we'll buy them internally, loan to cost initially with like a credit union, and then take them out to Fannie. And so a deal we did I think it was 2022, that had 6% debt on it with that was actually Community Bank. We want to refi. We want to get our money back, but there was like, we're not there yet. We like mid 4s if we can through Fannie on a 10 years. So what we did is we did a 3-year deal with the Community Bank at 6.15%, 3 years interest only. So we're barely going up in our monthly payment, but we were able to recoup our initial investment out. Even in this, but we're still recourse. That's the biggest hang up with it. And so hopefully in the next 3 years, rates dip back into the 4s, and then we put it on a 10 years. So I guess my question to you, my strategy is very simple. It's buying something loan to cost, renovating it, and then trying to take it out for 10 years to non-recourse Fannie, hopefully in the mid 4s. Love that. Do you think that I should not be doing that because I should be doing 5-year, like 5-year terms, 30 years? Do you typically do 5 years? Because I feel like that's what's coming, because 10 years may be a little long for you. But I'm happy sleeping well at night, knowing what the payment is going to be, locking for 10 years. So I'd just love to hear your thoughts on the term, the length of the term and our strategy.
So it comes back to the same thing, Jake, is you're looking at one side, right? I come back to this thing and I'll harp on it over and over again. Debt management is active, right? I know you sleep better to sleep well at night and you do it and you lock it away, but then go buy your real estate, go buy a credit tenant lease deal and say goodnight, right? Because you're missing half the opportunity there. People who actively manage
in terms of a lower rate or a potential cash
you're
out.
thinking about rates, like or
a potential cash out, I guess. Yeah.
Well, but you're thinking rates, and I'm saying no. Don't even think. Look, interest rates flow up and down all the time. I mean, I remember 6%, 7%. It's not, it happens. We're just off of this period where rates were so low, and because we can't get out of that, right? Your 4% Fannie deal probably won't happen for a while. So what are you going to do for the next?
Well, but let's when just a minute ago they hit 10-year hit what 480 was it?
Yep, 455, 460, probably.
Sure, it's 3. No, it hit 380.
And your 10-year is 450.
The 10-year hit 380 like a week ago. When it dipped hard.
Oh, yeah. Yep.
And so I guess my point was you could very well see 150 over, you get a point down. You could be, you're not that far off, 100 basis points from achieving that goal. I'm not saying it's going there. I have no idea, right? Because
Right.
we haven't really broken that 10-year of 380 in the last couple of years. Like that's been like the limit there. But things stabilize. Could you be there in the next year? It's possible. Who
But
knows?
no, because you're holding spreads flat. Spreads don't hold flat, right? So
Correct.
spreads
So you're
move
going to
right
150 at that point, right?
at, you're at that particular point, maybe not, right? Everybody widened out. And when the
no, but
treasury,
you're widening to 150 is what I'm saying.
no, what I'm saying is that the spreads have widened out. The spreads will widen when the market
To
when the
150.
Okay, spread to 150 over that. Yeah. And if you were able to lock and have your loan all set up that one day,
Yeah.
you got it.
Mm-hmm.
Right. But then now if you miss that window, right? Now it's 441 on the 10-year. Add the 150, right? Now you're up. But my point, Jay, is that it's you've got to think about all the other things, right? Can you go deploy your capital? Is the equity that you have in your property, what is that worth? And it's just a calculation. I'm not advocating
That's where the 10-year hold bites you in the ass a little bit because you have equity locked up that you could be redeploying. That's what I was trying to say. But so even if we took today's scenario, it's 435, right? You get a 100 basis point reduction. Okay, you're down to 335 plus a spread that widens 150 over. You're still at 485
Mhm.
on your rate, and so you know if you cash flow well, you won't recoup as much, but you will be cash flowing stronger probably during that period of time as well.
Yeah. Look, I mean, as I said, you can go all of these things, and that's the whole point, right? Listen to this conversation. We're just talking, and we're talking hypothetically, right? I mean, we're not even looking at a real deal with real cash flow and stuff like that. Because I could say, hey, you know what, guys, actually, you're crazy right now in this volatility. Go for a 3-year floater, right? Cap it or swap it, right? You could easily
That's what we just did. We did a 3-year swap, but it's fixed at 6. I think it was 608. We hit it perfect though. Like when everything was tanking the day that they had that whole tariff.
Very, very rare for us to tank it. Yeah.
We locked that day. But it was dumb luck, right? It's like, well, we're so smart. No, we were fucking lucky, right? So
That's the thing with this market. I mean, crap. Right now, I mean, you have professional traders that are, that I mean, everybody's hold is. I mean, we're talking like we're watching, the federal loan bank and stuff, seeing if they're deploying cash to make sure these banks are shored up. I mean, it's being so. When I'm not talking to you guys, I'm looking at a screen. I'm looking at my Bloomberg, and I mean, we watch interest rates. That's all we do all day is watch interest rates, and we watch these markets. And every Monday we have these market calls, and we're like, shit, it's scary. I mean, there's like this kind of volatility.
well, that's why it's hard to put a deal under contract because the rate could shift dramatically from the time you lock it up. So everyone's going, what the hell do I do?
Absolutely. And it's the same thing. Once again, it's about being proactive. It's watching. So if I could tell you right now, we didn't tag this volatility at all. Like this, tariffs all of a sudden coming and then going like that. That's just those are moments that nobody can forecast. But we've been watching. We're like, look, a few months ago, we were like, fixed rate's cheap. Go fixed rate, go fixed rate, go fixed rate. These 5-year IOs, buy them all day long. They're a great product. Don't worry about the prepayment penalties at the end. You'll make up for it, right? Because that's the other thing. When you do your 10-year deals, you've got to forecast based on your conversation before about exits, right?
Mm-hmm.
Well, in your exit scenario, are you exiting at a high interest rate environment or a low interest rate environment?
Mm-hmm.
And what's the cost of your debt? Because your Fannie Mae has a prepayment penalty, a yield maintenance penalty associated with it. And if you have a Freddie deal, it has defeasance. At least with defeasance in a high rate environment, you could be paying off your loan at a discount, which is what a lot of people are doing right now. So when you're thinking about debt and talking about debt, think about this. Your debt, you might have an outstanding principal balance of $8 million. But if you have defeasance, you could go to the bank with maybe 7.5 or even less. So your debt is actually lower. So you actually have more equity in your properties now if you have defeasance than if you had yield maintenance.
Rob, before we go to short answers, I really wanted to ask you, over the last couple of years, you've seen a lot of this short-term bridge, and it's gotten a bad rap because people have used it incorrectly. It's been around forever. Can you walk us through, like, what did people do wrong in 2022? Because Jake and I are looking at ourselves. We're buying 20 unit deals, 60 unit deals. 2023 really popped again for us. Bought a couple hundred units. Last year we had a couple hundred units. This year's looking good for us. But we were scratching our heads. We're like, we can't put deals in the contract. And it seemed like the Dunning-Kruger effect. We're like, everyone else is doing deals.
2021 and 2022, our acquisitions sucked. We couldn't find anything that made
It was
sense.
so hard.
You could, I mean, you couldn't. There's no way. I mean, it was crazy time, right? I mean, anybody, you just had to pay more than everybody else times two, right? You'd come in. I mean, we tried looking at deals, we couldn't even come close, and so but that's okay. And where people fell wrong there, it comes down to in a lot of cases, it was greed. Back then, a lot of the agencies and lenders did not require caps on your floating rate debt.
Uh-huh.
And a cap back then could have been $25,000 to protect yourself.
Mm-hmm.
And so, but once again, it comes down to timing, right? It comes down, once again, it's all about projected cash flow of your property over a reasonable time frame.
Mm-hmm.
Because if you're, we're up, I know, Gino, you're what, in St. Augustine? I've got properties up in Daytona and in Vero and those areas. And for us, we're looking at supply, right? I mean, all of a sudden projects are coming on board. And so we knew it's not like a project gets developed in 2 days. I mean, we know they're coming and we know that there's going to be a lot. So you have to start forecasting, am I going to get these huge rent bumps over the next couple of years? No. Okay. So then let's look at this and say, well, I don't think I have a chance to refinance in the next few years. What if I refinance today? It's going to cost me a little bit more, but it makes more sense because I know I can pull equity out. And my equity in my pocket is always a lot better to me personally than it is sitting there on a KPI or a metric that says, yep, my current loan to value is 45%. That to me just means I'm inefficient. It's just I'm under levered.
I agree.
Interesting. Guys, let's take a quick time out here from our sponsor.
This episode of the Jake and Gino podcast is brought to you by Wheelbarrow Profits, the premier multifamily education community. Wheelbarrow Profits proof is in their results. Their members have closed over 86,000 units. That's over $5 billion in student deal volume. Are you serious about taking your real estate game to the next level? Do you have the confidence to take action? Schedule a call with the Wheelbarrow Profits team today and supercharge your real estate knowledge. Build lasting relationships through unparalleled networking opportunities. Obtain lasting knowledge on how to buy multifamily real estate with intensive training. Gain hands-on experience through their live events with like-minded individuals and industry professionals, all while experiencing the personal touch and family atmosphere that set them apart. Visit wheelbarrowprofits.com for more information.
All right, we are back. Gino, you're going to be up again because you are the dad. All right, no, I'm kidding. I have some kids too, but Gino's got more than me, so I can always give him a nod to that. But we were talking a little before the show. New book out, right? Hey, Dad, is that correct?
Yep.
Can you talk to us about that a little bit?
Yeah, sure. So, for those of your listeners who are fathers or parents for that matter, nothing scares you more than a middle of the night phone call, right? And so I was sitting there one night, and it was probably 2:00 in the morning, and my phone rings. For me, I'm sleeping. This is not good. I pick up. It's one of my daughters, my older daughter. She's in her 20s, and I see it. I'm like, "What's wrong?" Like that's my first instinct. What is wrong?
What time did she call?
2:00 in the morning.
Ugh.
Yeah. Yep. 2:00 in the morning. And so it's what's wrong? Panicked, heart's racing. At my age, your heart shouldn't be racing like that. And so I turn around, she's like, "Can I put the green gas in my Jeep?" I'm like,
the hell's the green gas?
Well, it takes a little bit when you're sleeping. Like my mind's like, okay, you're not dead. I'm like, what? She's like, "Can I put the green gas in my Jeep?" I'm like, "Are you saying diesel? Like the green, the green?"
Oh, okay,
handle?
it's green on the pump.
It's green handle on the pump. Like, diesel? No, your car is gas.
Why are you not in bed right now?
Well, she was traveling. She was doing a road trip, and I knew she was doing a road trip with her friends to go look at places to live after they graduated. But you're right. It's like, what? But at that moment, I'm like, did I not teach my kids? I've got 4 adult kids, or in that adulting stage. Did I not teach my kids what they need to know? And then I started talking with other parents. They're like, oh yeah, my kids call me. They're like, they asked, hey, why do I need a bank account? I've got Venmo, right? And stuff like that. Or hey, tax time. You know, I mean, I'm like, I'm not an IRS person. Like, I'm not a tax person. Like, and I'm getting all these tax questions. So my wife was like, you know what? Why don't you write a book on all the stuff that they ask you and just
That's
do a
so cool.
book on all the stuff that you should know, but you don't about being an adult. And I was like, you know what? That's a great idea. I enjoyed writing my first book. Yes, it's a
And you have
business.
4 of them, right?
I have 4.
That's a good, data set there. There's enough diversity, right?
Well, I went beyond that too. I said, you know what? Because my kids don't believe me, and so I'm like, you know what? I'm going to go out and I'm going to go interview 30 experts in all fields of things. From I interviewed a guy who won NASCAR. He's a NASCAR professional NASCAR driver and his crew chief. He won Daytona 500. He's won all these other races. His name's Michael McDowell, and I interviewed him and his crew chief on maintaining a car. You know, because obviously they know how to keep cars that are beaten up. I interviewed the woman who runs
Green
property
gas.
management for Graystar, like how to get an apartment. I interviewed tax expert, like all these people, and I basically put this book together. And it's not like a everything you need to know, but it's foundational. Every kid, you know, you think about this. Our kids growing up, they're almost on those. You know, at the airport, they have those walkways that move for you. I call them the magic carpet ride, right? And so you get on it, and you're sort of brain dead as you go along on
You
this.
don't run them?
Yeah, no, you just sort of
We
walk. I like to
typically
walk.
run them.
Yeah, I like to walk fast. But I like our kids' lives are like that. They get on these things, and they're in first grade, second grade, third grade, so on and so forth. And then all of a sudden, this magic carpet ride stops, and they're like, "Whoa, what do I do now?" I don't, I had this major, but that major is not hiring right now. What do I do? Where do I live? How do I get an apartment? Like I always had student housing, or I had you help me with my apartment and all these things. So I built and I wrote the book around foundations. One, get up, get out, because you need to start growing up and sort of figure out what you want to do. Second is how to get a job, which means you actually have to use your mouth and talk and network and meet people. Get a place to live, find a car, learn how to do your adulting stuff that we all have to do: bank accounts, investing, taxes, insurance, all those things, becoming a good adult and a good human. And then finally, an emergency section, because when you're an adult and crap happens, it's not, you don't have time to go Google search, right? If you're stuck on the side of the road, or somebody's in trouble, or you're in a bad spot, you don't have time. And so everything from Navy SEALs to paramedics, all this really unique collection of people I interviewed to give me the content for this
This
book.
should be called Foundations for
Yeah.
being an adult. Right?
I
The
like
basics.
it. I like it. But mine was, it was funny because we said, "Hey Dad," because it's always, it's always
That's a great title.
"Hey Dad, how do I," and it's always the same thing. "Hey Dad,
Well, it's
how
better
do
than
I,"
Hey
or "Hey Dad,
Siri.
can I?"
You got a good relationship with your kids because they could just be talking to the box. So this is better.
Well, I actually made an AI app because I figured, for some who aren't even going to read the book, and the way I wrote the book too was I wrote it very short, just like if you saw Beyond the Building, it's very sort of condensed. I even made this book even more condensed. And at the end, I have this section, it's too long, didn't read. And it's just basically bullet points of what you need to know. And then if you're still not doing it, I have an AI app that you can just go in and ask it, and it will tell you what you need to know.
Yeah, this is great. The way I explain it to my daughter is I tell her, when she's getting ready to go out into the wild, and it freaks her out. She goes, what do you mean out into the wild? Like we're doing, every night we do multiplication, right? She's 10, and I just want her nailing this stuff because I feel like it's a basic, like core thing that she needs. And she's, why do we got to do this? And I said, because when you're getting ready to go out into the wild, I want you to be self-sufficient. And I think that sort of, she's like, what do you mean? Like out in the wild? I'm like, no, you're going to go out there and take care of yourself. She's like, it's not wild out there. I said, yes, it is. We homeschool. It's a very controlled environment here. You're getting ready to go out there. You need to be able to protect yourself and think on your own. So I really like explaining it that way. And I was thinking back to the phone call that you got. People need to have more self-awareness. We got a text last night. It was like 4:30 a.m. from our piano teacher that she wasn't going to make it in. I'm like freaking out. Who's calling? What the hell's going on?
4:30
Like,
in the morning, right?
dude,
Jesus.
after 10 and before 7, all right? No, unless it's an emergency, because you freaking people out, folks. Anybody out there, 10 to 7, off limits unless someone's dying, all right?
Yep, absolutely. Yeah, I mean, that's my prime time. But so I'm going to give you a little piece of advice, Jake. I'm not to say anything,
No,
but
give it to me. I need it.
here you go. The number one thing that I've seen that parents should be working on with their kids early on. The math skills are great, and yes, you need them and all that stuff. Learning how to communicate with adults and other people.
Look them in
And
the
I
eye.
look them in the eye. Look, I tell this to I every time I've talked about this book and people have asked, well, what would you teach your kids again? And said learning how to network. I'd put them in more experiences with adults because what's ultimately going to happen is like some boy comes up to try to date one of my daughters, comes up, he doesn't look me in the eye, and he gives me a little weak, flabby
You
handshake.
slap them, don't you?
Yeah, I'm like, no,
Wake the fuck up, man.
you're out. You're out. Like you don't even come close. Like shake the damn hand. Like you have to learn. But I've also noticed in the past 25 years, we've hired recent college grads to be our analysts. And we put them through a program. In the past 25 years, they have changed considerably. They're very comfortable in technology. They blow everybody away in the technology. But the comfort that they have in talking
They're
and
meek.
networking.
Yeah.
And so teaching young adults early on to talk to other adults and to have
No,
conversations.
to making kids speak to adults in a confident manner. One thing that we do whenever we go out to a restaurant, I actually make my kids go up to the server and tell them what's happening.
Yeah.
And they're like, oh, me, Gino does this, ooh, ah, and they're like, ooh, yeah, I don't want to do it. But then they got to go up. You're going to go up there. You're going to look them in the eye. You're going to tell them how many of us there are, what we're looking for. We're looking for a booth. And they have to, I'm forcing those conversations.
Yeah.
And it was, at first a little awkward, but we're getting there.
Take them out to have them business meetings. Have them do your business meetings with you. I think the more you can expose them. Now, granted, you're not going to do every one, and we always have those friends that have their kid with them all the time.
It's exposure, though. You're right.
It's getting them exposed, getting them into these things. I think other than that, my dad, who's in real estate, owns stuff, he's also the same way. He's like, he believes that the best thing for training, if you have any young adult, is to put them on site, right? You have to be an on-site property manager before you can work for my dad, right? And so that means I've been on site, my son's been on site, and not that we want to be on site residential property managers, but at least it gives you the exposure to deal with people. And outside of that, getting your kids to be exposed to what you're doing and how you're communicating with other people and making them communicate is really important.
Well, something so stupid the other day. It reminds me of what you're saying. My wife was freaking out, and she didn't probably handle this very well. But she ordered flowers for somebody, and they gave them the wrong one. So she's like, "No, I want my money back." And my 6-year-old's running in here. She's like, "Oh, mom's freaking out." I'm like, get back out there and listen to her. Don't be a little like sissy. Get back out there and hear what she's got to say. Like, because he thought something was wrong, but no, she was giving this guy the business on the phone. And I'm like, I don't want to like exclude him from hearing that. I'm like, dude, go listen, find out what's going on. And then my daughter wanted to fight him. So it was like, you get these interesting dynamics here. Gino, my takeaway from this is I love his parenting advice. And I think that he thinks that we got fat, lazy 10-year money out there. And I'm not sure how I feel about it at this point. So I'm going to sit and meditate on that one. What say you?
It's interesting because if I could add a couple of points to what Rob's saying, I've got a 25-year-old who's going back to becoming a missionary. I've got a 23-year-old son. He has 9 K1s. He's invested in 9 of my deals. And it's annoying because he's diluting me, but it's just incredible to see what's happened. I've got a 19-year-old who's got a massage business. So what we do every 3 months, I get on a call with our bookkeeper, and they all have their own LLCs. They've started their own LLCs. I've never started an LLC in my life. They know how. Every year, my son goes in. He's got his license, federal firearms license. So he's got an FFL license to sell firearms. It's incredible. Like at 23 years of age, I wasn't doing that. And I think he's seen what we've done. And I think kids mirror their adult parents. So I think being the role model is one thing, and leading them and guiding them is another thing, and giving them the guardrails. So getting on those quarterly meetings I have with the bookkeeper, I think that's what you're talking about. They know how to speak to a bookkeeper and an accountant, and their language becomes their experience. They know what cash flow is. They know every quarter that they have sales tax due. They know that today is tax day. And oh, by the way, Dad, did we actually extend our taxes and are our K-1s ready? Like, what 23-year-old knows what a K-1 is? Very few. Most adults don't know what a K-1 is, but my kids do. And it's not just a testament to, our parenting. Is just, I fell into it and I'm like, I want to raise adults that are able to make their own decisions. That's what parents are there for. We're there to teach them. We're not there to ultimately tell them what to do. Where they may be on when they're a little bit younger, but as they get a little bit older, having the ability to not avoid making decisions, but the ability to go back into their database and say, well, what would Dad have told me? And how can I make this decision based upon my values? And I think that's important. That's part of the legacy component of it. And I think that parents sometimes don't want to talk about money and they feel uncomfortable about it. But I think if you start shying away from these subjects and start avoiding these subjects, it does no service to your children, because when they become adults, they don't know how to actually think about it and contemplate about it. Look at the critical thinking that's going on nowadays. Nobody critical thinks anymore because there's no skills, and nobody actually knows what money is because nobody's been taught about what money is a result. Money is something that you aspire to. We're not aspiring for money. We're aspiring for autonomy. That's if you can teach your children that money's not going to make you happy, but get a job that will make you happy, because then the money you'll earn, you'll want to do it more and more. So I can go down this rabbit hole, but I totally agree with what you're saying, Rob. And I think us dads need to step up. I mean, dads have not done the job that we're supposed to be doing over the last several years, I think. And I think what you're talking about, what you're espousing to, is really the responsibility element to, like, let's start becoming, much more, I guess, dads and empowering dads.
Yeah, but I think in fairness, look, we're all the same, right? We're all working hard. It's not like we're sitting on our couches eating bonbons and not taking care of the kids, right? I think one of the things that I came up with was probably a lot of this book could have been a little bit of guilt too, right? I spent all my life building a business and traveling and doing everything I could because I thought that's what I needed to do, right? That was instilled to me to provide for my family, and so coming back when I'm writing this, I'm like, geez, maybe I didn't do all this. Maybe I wasn't a good father. But you're right. It at the end of the day.
That's why you're taking that 2 a.m. call, man. But it's
right,
all good.
Right. At the end of the day, it's like, the buck stops with me. I'm the CEO of the family. I'm the CEO of the business. And that's what is right. But it's about building good kids and letting them. The other thing too, though, is that I think one of the things I've noticed too is when you talk about money and the importance of money and having the basis, a lot of kids look at the wrong thing and they don't understand where people make money. And if they're getting their insight from
it's so hard with social media, dude.
Instagram and TikTok, it's like, oh yeah, this guy, he's traveling around. I'm like, geez, this kid's like 20 years old and he has a G650 and he's traveling all over the world. And he's like, wow, this guy's great, but you can't compare. I have no idea if that was just borrowed, if it was fake, it was AI. I have no idea who this guy is, right? He might not have anything, right? So it's hard, but these kids, that's who they aspire. And they think that could be realistic. And so that's where it's making sure that they have a good foundation of what it takes to make a dollar.
Well, especially when you do this kind of stuff, you do podcasts, maybe you have social media. People think like all the money is generated here or some sort of online business. And it's like, no, all the money's in the buildings, guys. This is, we like doing this. It's fun, but this is not the revenue generator right now. So
right.
It's crazy.
Right. Yeah. Try writing a book. Well, yeah. Gino, I mean, it's not like, you're not retired.
You're going to get
rich. unless you're like selling 1 million copies, which, like one book does, it's hard. You do this out of passion and enjoyment, and you guys, you have a great thing. But yeah, our business is our business. This is what we do to contribute and give back to society.
So to give the book some support here, where can folks get it? Maybe there's a website for the AI and all that stuff. Love to make sure we get that out to everybody.
So it's heydadbook.com. And you can get it there. It's heydadbook.com. You can go to Amazon, Barnes and Noble. It's on all of those.
You got it on Audible?
It will be on Audible. Yeah, it's on Audible when it's actually officially being released at the end of next week. Actually, I have to get to go up. I'm pretty excited to get to go up to Times Square and at the Barnes and Noble and do a signing. So
Make sure you get your picture on one of the big screens. I heard it's not.
it is. It's
not
they
that much
actually
money,
got
right?
that. I'm like, great. That's all I need is.
Well, put it on social media, and people think you're rich because you're on Times Square, right? Not
Exactly.
because you have buildings.
That's it. Then I'll do my speaking tour, and then I'll be perfect. Yeah. But yeah. So they can always go to my website. It's robfinlay.com, and that's got all the the Beyond the Building. It's got all the other stuff, and I'm on Instagram and all these other things. So,
He's on all the doodads, Gino. All right, take us home, big guy.
Well, Jake, Rob did not mention how he started out in real estate. He mentioned very little, but he was I'm a guy. I'm going to do this. I'm going to do that. And my dad wants me to change toilets and do sheetrock. And Rob's like, bro, I ain't doing this. It sucks.
I want to go to Wall Street, man.
Yeah, my friends doing Pokemon, they're hanging out, they're playing video games, and I'm doing this crap, and I don't like this. And I think investment banking is the gig for me. And the interesting thing, as you read his book, the background that he had in real estate gave him an upper leg or gave him an advantage about everybody else because he saw it as a real business. As a scalable business where other people were just looking at spreadsheets, and spreadsheets are sexy and they're cool, but it's not just about the data and about the numbers. It's about understanding the numbers and then putting that into practical play. And I love how you say it's really a business because at Jake and Gino, we always said we create multifamily entrepreneurs. That's what you're doing when you're getting into real estate. I thought when I got together with Jake's going to be riding a lawnmower. We're going to have a couple hundred units. We're going to make some bucks. We're going to have fun, make some cash flow. But then we started understanding as we're scaling the business, it really was a business. And if you don't have your OKRs and you don't know what a KPI is, you're going to become the mom and pop who sells to Rob Finlay or who sells to Jake and Gino. And with this podcast and with Beyond the Building, Rob's book, you can avoid becoming the next mom and pop casualty.
Love the title. Hey, Dad. That's so cool. So, gang, as always, we believe in buying deals for the long term. Think in decades. I'm Jake. He is the G Daddy, and we make it happen. We'll see you next time.
Thanks, Rob.
thanks, guys.